We heard from the Federal Reserve and from Chair Powell this week, and maybe the headline is the uncertainty because of the war in Iran. He was very careful in saying we don't know what the effects will be, big, small, or in between. How does one make policy in the face of that kind of uncertainty?
Well, writ large, that's the job of the Fed generally. The Fed is always in a position of uncertainty. That uncertainty may be greater from moment to moment. It's obviously at a fairly high level now. But that's really what's behind the Fed's regular mantra of we'll be data dependent. It's the data could be different next meeting than they are today on the basis of what we know now. This is where we would be likely to go. I think, however, when you're at a level of uncertainty like this, you have to look at what you think the fundamental drivers of the economy are likely to be, as you think going forward. And I think that those drivers currently are more inflationary than non-inflationary, and will therefore probably argue for probably no change in the Federal Reserve's monetary policy stance for some time into the future. I don't think that where the economy is going to argue for raising interest rates. But I think the argument for lowering interest rates is going to be hard to carry probably for the rest of this year.
On the uncertainty, just for one more moment on that, at what point does the uncertainty itself start to weigh on the economy? Because businesses might be reluctant to make investments, consumers may hold off on spending. How long can we go before we start to see it, you think, in the economy?
Well, I think you start seeing that relatively quickly. In terms of lowered business investment, because you don't know exactly what environment you're investing into. We saw that at Liberation Day. There was a significant pause in business investment until companies felt that they had their foot on a rock with regard to where tariff policy was likely to go. And so you'll see that again now. The question is, how long does it last before that becomes sort of a material drag on the economy?
Tell us about demand destruction. I'm reading about that a lot these days, which is not something you want necessarily. What are the risks of that, and at what point might we start seeing demand destruction given what's going on, particularly with the energy markets?
Again, you're going to start seeing responses pretty quickly to higher energy prices in consumer spending, and again, because of the uncertainty about the future macro environment and business investment. If that's relatively short, if we're talking a resolution in a month, even in 2 months, then that's from the point of view of the Fed, which looks over long arcs of time, a blip. If it goes on longer than that, then you'll start to see reaction. But on the flip side of that, which is partly why I think you're not going to see a hike in interest rates, but you're not going to see a lower interest rates either. Those are effects that slow the economy. But higher energy prices feed into higher prices generally, and that's inflationary. I think a lot of the other drivers of the economy, the fiscal stimulus that you have from the One Big Beautiful Bill Act, which I thought was excellent legislation. It provides the right incentives for the economy, but it is stimulative and pushing upward on inflation in the short term. So I think the balance over the course of the next several months is likely to be in favor of no moves, either down or up.
One of the things we heard from the Fed this week was that the neutral interest rate has ticked up a little bit, I think from 3.0 to 3.1. What is driving that? Is it some of the factors you just suggested, or is it some other structural things such as AI investment?
I don't think that AI investment is driving a change currently in the neutral interest rate. I think it's too early, for us to see that sort of an effect. I think it's more the factors that I was talking about earlier. And I think part of this too is that the Fed is beginning to recognize changes in the overall environment that have been pushing upward on the neutral interest rate for some time. I think their sort of institutional estimate of the neutral interest rate has been lower than warranted for some time, and they're catching up to where the actual neutral rate has been for a while.
We saw in the Fed in the summary of economic projections both a slight increase in, particularly in core inflation, but also in growth. Where does that growth come from, do you think, at this point?
I think you'll see growth across the economy. I don't think that for example, that the sole driver of growth is AI investment or AI changes in business processes. Again, I think we're too early for that. But the economic policies of this administration have been quite supportive of growth, and in particularly the fiscal policy of the One Big Beautiful Bill, and those effects will be felt throughout the economy. And the elements of the administration's economic policy package that at the outset of the administration one might have thought could have slowed growth, for example, immigration policy, maybe tariff policy, have ended up to be not as slowing of growth as one expected at the beginning. So of the overall administration economic package, which I think was much more coherent and well thought out than a lot of people give it credit for, I think that the stimulative elements are outweighing the potential growth slowing elements. And so as a consequence, we'll see that stimulation across the economy.
You mentioned tariffs, and goodness knows there's been a lot of talk about tariffs. What I took away from what Chair Powell and the Fed said was basically they do increase prices for a time being, but it's usually 8 months to a year, and that'll be up sometime in the middle of the year. What are you seeing out there in the real world? Is that consistent with what you're seeing?
Yeah, it's very consistent. There's a slightly higher risk that tariffs could feed into overall inflation expectations just because of how this tariff policy has been rolled out, because it's been up, it's been down, it's been rolled out over a long period of time, as opposed to develop, explain, implemented with a delay for everybody to process it, which would be the typical way to implement tariff policy. And then it would be very clear that you have kind of a one-time step change in prices during the period of implementation of the tariff policy that shouldn't feed into overall inflation expectations. There's a slightly higher risk that you push up inflation generally for a longer period of time just because of the way the tariff policy was rolled out. But I don't think it's terribly high, and I think you can expect the Fed can kind of expect to look through tariff policy. The tariffs themselves are not nearly as high as people thought that they might be at the outset of the administration.
You mentioned immigration policy, and it did come up in the news conference with Chair Powell in this sense. He said, look, we still have sort of a low hire, low fire labor economy right now, and therefore the unemployment rate actually is not going up. But he said that's not a really great balance. What are the risks in that sort of employment market?
So I actually think that people are underestimating the degree to which the labor supply has been changed as a result of immigration policy. The administration hasn't really succeeded in forcibly deporting very many people. That's hard to do. The Eisenhower administration tried to do something similar and had sort of similar results. But the policy had the effect of almost immediately closing off the very large amount of illegal immigration that there had been during previous years. A certain amount of self-deportation and even legal immigration is down materially. So the growth in the labor supply that we had during the Biden administration has been closed off by a very significant amount, really maybe between 1 and 2 million people a year, I think. And so the softness that you see in the labor demand numbers, in the jobs numbers, I think people are underestimating the degree to which that is effectively offset or significantly offset by the shrinkage in labor supply. You layer on top of that just the continuing aging of the baby boomers. And so I am less concerned. And I think the data that you described are supportive of that lower level of concern than the Fed has been expressing for some time about the state of the labor market. And I think as the data continue to evolve, that will be another sort of support for interest rate policy that is on the higher end rather than the lower end of expectations.